Hey everyone, welcome to our market update. We are the Hatch Homes Group, and today we're going to talk about the housing bubble again. We're going to compare today's market to how it was during and before the bubble and the Great Recession. And before we get into all of our points, I wanted to just remind you guys to, if you're enjoying this information, please remember to subscribe and like. We would love for you to get our regular weekly updates. Okay, why are we talking about the housing bubble again? Well, we've seen double digits price year over year price increases. And, we're always reading on these comments on social media, people saying, oh, it's going to crash and burn again,
Right.
Yeah. So we hear that a lot. So we just wanted to talk about that. There's some really, really important differences. And first one is affordability.
Affordability. I know it may seem crazy to say houses are more affordable now than they were in 2007, but there's some key components as to why that is actually true. And that comes down to basically a formula of what your income is, what the actual price of the house is, and what interest rates are doing. I really feel that, back before in 2007, wages were lower, housing seemed high for the time, but interest rates were 6% or higher. And these days, wages are higher. While prices are still higher, wages are higher to catch up with that. And interest rates are actually lower, and they will probably maintain that until the end of the year, hopefully below 6% for the foreseeable future. And in conventional financing, they say that you're not supposed to spend more than 28% of your income on your monthly mortgage payment. And you can see from this graph here that back in 2007, or with normal lending standards, there was like 34% or higher of your income was being spent on your monthly mortgage, which is simply not sustainable, right? And these days it's calculated that we're just under 26% of our monthly or of our income is being spent on our mortgage. So I think that that's a really big factor when you're seeing that everything seems so expensive and you're feeling like it's really expensive. Remember to put those things in perspective of what percentage of income you're actually spending on housing.
And I've got another example. I just watched the vision speech of Gary Keller that he does every year, looking at the market. And to put things in perspective, he compared 1989 with today. And if you looked at wages, you'd see that wages have increased 13.85%, accounting for inflation. But loans are 24% cheaper. So amazing difference in all those years. Yeah.
That's really interesting to think about.
Yeah,
absolutely. And when you look at also that 34%, Michelle, who are spending 34% of their income, the lending standards were a lot more relaxed, and you're putting little to nothing down on that. So people didn't even have equity in a lot of these homes that they couldn't even afford the payment in. Mm-hmm. And with them being, look at this chart. And Angela, didn't you buy your first home in that time, like as a part-time barista or something like that?
Yes, I did. And I definitely would not qualify today if I still had that same financial situation. It was, and it was low down. It was kind of stated income, like future stated income, pre-approval. And my monthly payment was high for how much I was making. Like it was a push on my affordability. We were eating, ramen.
Yeah, exactly. And so you didn't have a bunch of equity in it. And so that would be like a higher risk loan. They did way riskier loans back then, as were the standards for after 2007 from 2008 on. Just look at the graph. Yeah, it's a lot more strict and a lot more sustainable.
Yeah.
Like John.
If you combine the, you're getting a low down payment, you already have poor credit, and then, the market changes, you're you got no skin in the game here.
Yeah.
Exactly.
I like John's analogy of like, you can get a loan back then if you could breathe on a mirror and it showed that you're breathing.
I was one of those people. The last time we refinanced, and it's very, very easy, not only to qualify, but to get home valued. I think I got a mortgage close to 100 grand more than the house was really worth. And a lot of people were doing that, taking this money and then buying other properties with very little equity. And then when it crashed,
or buying things that didn't really help their investment situation. Like they take money, all their equity out, go buy a boat, like.
Yeah.
Oh my God, that's so true.
So Johnny's talking about lending standards, and what comes to mind is we're used to having these cycles. We have a big lift in the market, and we're going to have a crash, like often happens with the stock market. That doesn't necessarily have to be. If you've got good lending standards, like look at Canada. Canada has had very strict lending standards consistently. They have had no bubble. They have steady growth in prices, quite enormous growth recently, but there's no sign of any fluctuation. So we're conditioned from these things that people talk about in the past, but it doesn't have to be.
Exactly. It's not as volatile. Mm-hmm.
So that leads to foreclosures, right? And I'm going to talk a bit about. It's interesting with foreclosures. I've seen so much in the press about foreclosure boom coming, and we've had this moratorium on mortgage payments, and the moratorium's ending. So, there's going to be a flood of foreclosures. Even people have approached realtors and said, you've got to get trained up. You've got to do this course on handling short sales and handling this foreclosure flood that's going to come on the market. It just isn't true. It's a complete myth. And you can see from this chart, we have a decreasing number of people that have negative equity so that they would have to go into foreclosure. The majority of people, if they need to sell their home, they can sell it and at a profit. So it's just, we have a crying need for properties right now. We don't have enough homes being built. So I just don't think foreclosure is an issue. Whereas the last bubble, there were people buying these homes with no equity, hardly, and was
totally different situation.
Totally different situation.
Yeah, you got high monthly payment that's pushing your affordability anyways. You got nothing in the house, and then your value goes down. And then that one person that on your block that has to go into foreclosure or sell it at a discount for short sale affects the comparable sales, and it just keeps going down, down, down. We saw it. We don't need to be trained up on short sales. That's like, we've been there before. We know that market.
And we hope it won't go there,
Well, and inventory is the biggest thing. And I'm almost sick of hearing myself say inventory.
I know, right?
But like, we actually heard it recently. We don't have an inventory problem. We just have a huge demand. So we have homes coming on the market. We just have extreme demand. And that demand is really focused on affordability, right? So we have demand because of affordability. We have demand because of population growth. We have, we have all these millennials becoming of age to buy a house. We have rents increasing. So why would I pay all this money on renting if I could buy, and the affordability numbers make sense? We have low interest rates. So all of these things are creating demand. And then we have low new construction starts. Whereas in the past, the past bubble, we had major new construction happening. So we saw this graph and we were like, it's not really fair to compare the inventory levels during the housing crash versus the last 4 years. So what we wanted to do is we wanted to look at inventory before the crash, which I think is a more valuable comparison. And
Yeah.
bear with me because I know this is a lot of numbers and some people might be like, like, oh, too many numbers. Like it is important to talk about. Like if you look at 2004, 2005, 2006, booming, that was the booming prices going up. Inventory levels were sporadic. Like they were very inconsistent. You had 6.1 month inventory in January. Like we haven't had a high inventory January in years. And then you would have so you'd have 3 months and then you have 1 month and then you'd have 2 months and then you'd have, 4 months. Like that's not how our inventory has been for the past. Like we haven't seen more than 2 months in a given month, for more than 3 months in the last over 2 years. So we've been consistently low, which is, it's been a little bit more consistent. And I think that those are important things to look at. Like if this was going from 1 month for years and then up to 9 months, that would be scary, but we can look at these patterns and I think feel a little bit more comfortable that because of all the things that we talked about today, we're not seeing how it could just burst. Right.
I mean, things will change as they always do, but it won't be the same as it was before. We got to look forward, right?
You don't have to have big cycles.
Yeah.
Don't have to. Yeah. And obviously, if interest rates went crazy high and really messed with that affordability, that's the biggest thing I think to consider in terms of changing the market. But, we're going to continue to have these conversations as long as we keep hearing people say don't buy, it's going to burst.
Right.
We get it. Like a lot of people had to deal with it, went through some really hard times during the Great Recession. And remember, that was a recession caused by the financing and housing industry. It was caused by it. So of course it was going to feel the most effect by it.
But it's different now. And we can talk more about it with you and your situation and what you need and your questions. So subscribe, listen, reach out anytime. Thank you for listening. Have a great week.
Yeah. Thanks for joining us.
Yeah.